is the closing bell on Wall Street, and now it's market domination overtime. Let's get you caught up on where the markets did close today. Taking a look at the popular averages, it looks like we're going to finish in the red here. The Dow down about 244 points. The S&P 500, your broad gauge, is going to finish down about 0.3%. And the tech-heavy NASDAQ is going to finish down about a tenth of a percent. So major averages do take a bit of a breather here. This is the U.S. government shutdown, we know, is rolling on. The market has not been really too concerned with that. We have been talking today with guests, though, about what that could mean for the economy, for the Fed. Speaking of the Fed, investors did kind of parse through remarks today from Fed speakers. You heard Governor Michael Barr sounding more cautious about additional cuts. On the other hand, we had Fed Bank of New York President John Williams. He was talking to reporters, talking to press, that he actually backs more cuts this year. So the discussion and the debate among our central bankers continues. Soon, of course, investors, they're going to have a lot more data and a lot more insight to think about as earnings season truly now starts to ramp up. Well, digging deeper, tech stocks have been the driving force of this market for nearly 2 years, but one major fund manager says that dominance could be nearing its breaking point. Brian Kersmanc, portfolio manager at GQG Partners, joining us now. Brian, it's good to see you. I do want to get your thoughts on tech, Brian, but before that, I want to get your take on some comments from Jamie Dimon. I don't know if you heard these, Brian, but these certainly got some attention today. You know, when Mr. Dimon speaks, people tend to pay attention. He was talking with the BBC, and he said, he was kind of talking about this potential for a correction, Brian. I don't know if you saw this, but Mr. Dimon saying, I am far more worried, he said, about that than others. Now, he didn't give a specific hard timeline for that correction, but I'm just curious what you think there. Listen, I mean, we've had a big run off that April low. I've had any number of strategists come in here and tell me valuations are stretched. Frankly, Fed Chair Jay Powell seemed to suggest we're kind of stretched. What do you think, though, of Dimon's comments? Would you be expecting a correction here?
Yeah, so I think what we're seeing right now, as other guests have mentioned over the time in the past, is that we are a little bit stretched by a number of metrics in a lot of different areas. And I think if you look at the fundamentals, a lot of what has driven sort of the growth and the market performance has come from the specific set of tech names, or even these names that have been sort of parallels to sort of that tech thesis over the course of time. So if data centers are coming in demand, then you have more electrification trends and those types of things. And really what we're getting a little bit more concerned about is that expectation of where that comes from, where that drive, that headroom is coming from to actually drive a lot of that spending and sustain that. That's what has us a little bit more worried, because as you start peeling things back below the surface from a macroeconomic standpoint, it's not as rosy as I think a lot of people are making it out to be.
So when we talk about this sort of AI spending boom, which has been so critical to this market, Brian, do you sound skeptical? You know, plenty of other folks have sounded skeptical. You've heard very well-known investors saying they even hear echoes of 1999. What do you think of that?
I think what's interesting, if you actually look at our own history, it's not that we've always been tech bears. In fact, if you look at our U.S. equity portfolio, call it 18 months ago or Q1 of last year, we were the better part of 70% plus exposed to tech and sort of the tech derivative sort of plays within the portfolio in the grand scheme of things. So we have been very bullish on this theme in the past, specifically with names like NVIDIA and things like that. What has us increasingly concerned is as we continue to peel back the onion on tech, I think one of the things with AI in particular, you have to ask yourself the question, if I were to take away all of this generative AI tomorrow, how would my life actually change? And where is the usefulness coming through of that? And that sort of fuels that question as well. You look at all of the spending that's happened, $600 billion in CapEx that have been spent. And really, what are the total revenues that we've seen on the other side of it? It's about $30 billion. And who's been the most successful company in terms of driving this, at least on the consumer side of things? It's been OpenAI with ChatGPT, with 700 million users globally in terms of monthly users. But then you think about, well, how are they actually monetizing this? Only 2% of people, they have a 2% conversion rate in terms of revenues. So 98% of people aren't actually even paying for this thing in the grand scheme of things. So as you start to peel this onion back, both on the consumer side and then you start getting even into the enterprise side of things, where you could potentially do or not do things with these large language models, we become a little bit more skeptical that there just isn't as much headroom as people are baking in to their assumptions at this point in time.
You're about, Brian, of course, to get a lot more insight into all this because big tech earnings are on deck here. Do you think this earnings season here, Brian, do you think this is sort of is it a make or break moment for the AI trade and trend?
To some extent, it is a make or break moment because a lot of what's driving this sort of AI fuel in terms of the dollars that are coming through is the CapEx. And if you think about where the CapEx sort of drives things, think of like a hyperscaler. A hyperscaler is depreciating these assets, this CapEx, over the course of a 6-year time period, right? But these assets are being deployed now, the CapEx that they're actually deploying now. So that's showing up in the tech earnings right now. And as we know, when it comes to the markets, everybody looks at that second derivative. So if you see a slowing down at all from a tech spending perspective, you could see these things start to tapering off. And I think the other thing that we need to sort of acknowledge here is that the big part of where the spending is coming from and where people are actually doing this is on the cloud side of things and cloud compute. And what's interesting about that is cloud compute used to be a really sort of profitable, high margin sort of business for the AWSs of the world, the Google Clouds of the world, the Azures of the world. It's a nice little oligopoly of a business. But as we've seen more recently, there's a lot more of these former crypto players or other folks coming into the cloud space, and they're really driving these returns down. And that's what has us worried as well. You think of a company like an Oracle, for example, who's coming in and really muscling in and driving pricing down. They're 40 to 70% price cuts on the enterprise side for cloud. And I think we've seen sort of the reports recently talking about the unit economics, how their razor thin margins are coming in. That's depressing the margin in the whole space. You're seeing that within AWS in particular, in terms of driving those margins down. So it's not as attractive of a business as it used to be, and it's much more commoditized as it used to be. And again, this is the underpinning of what all the AI spending is at this point in time, is really that cloud growth, really driving that over the course of time.
So Brian, I just want to end here then. If you're skeptical on tech, Brian, fair enough, where is the opportunity? Where are the sectors you want to overweight here?
It's a really interesting question because, as I'd mentioned sort of at the top of the segment, it's hard to find a lot of these areas, especially things that have done well on a year-to-date basis that doesn't have some sort of tangential parallel or a thesis that's attached to this. So you think of like European cap goods, a lot of that's associated with the electrification trade. Even some of the better performing utilities, for example, are sort of these unregulated utilities that are in the power demand and things along those lines. I think what is interesting right now, if you look at our portfolio, the composition, we're about 20% exposed to more of the regulated utilities in terms of our portfolio. It may sound like a keep you rich type of area to invest in instead of a get you rich type of area. But what we're seeing with the utilities is there's population growth moving to the southeastern states. So the Floridas, the Georgias, the Carolinas, and Texas, and they're moving from these other areas. This has been a trend that's been happening for a number of years. And you are seeing that baseload power demand is coming through in these areas, and that CapEx is increasing. And the difference is with these regulated utilities is whether that demand comes through or not, if they get approved for that CapEx spending, that elevates their growth. What does that translate into? Call it high single-digit EPS growth, 7 to 9% EPS growth, and then I get another 300 basis points of dividend yield on top of that. If I can generate a nice double-digit type of return for a company that I'm paying mid to high teens in terms of a PE multiple against an S&P 500 multiple that's in the low to mid 20s, that looks really attractive to me, and it gives me a high probability of achieving high single-digit, low double-digit returns with little multiple compression.
Brian, great to have you on the show today. Thank you.
Thank you so much.
Intel doubling down on its comeback, unveiling a new AI chip while also pushing deeper into humanoid robotics. For more, we're bringing in Yahoo Finance tech editor, the one and only Dan Howley. Dan.
Yeah, Josh, they're coming out with basically their much long gestating 18A technology, right? Gestating, delayed, feel like one is nicer than the other. This is their Panther Lake chip that's going into laptops, desktops, what have you, any kind of consumer device that you can really think of that would use a standard Intel chip. It's based on this 18A technology. Now, the code name is Panther Lake. When you go to the store, you'll see it. It'll be the Core Ultra Series 3. So not really the easiest name to, you can't go, oh, you got a Pentium inside or something like that, right? It's like, you have a Core Ultra Series 3, but that's besides the point. This is a big moment for Intel, and the fact that they got chips now running on their 18A technology, which has been a big deal for them. They're building them out of their plant in Arizona, it's Fab 52. That's going to be dedicated to these. They also have a data center version of an 18A chip that they're also going to be launching. It's Xenon 6 Plus. And so it's a huge deal for Intel on multiple fronts. The first is getting 18A out, right? This has been something, it's a huge test for Lip-Bu Tan, the new CEO. The other is obviously launching that plant, having these chips come out of there. That's something that President Trump has been really pushing, saying, look, we want to bring more semiconductor manufacturing. Well, here it is. As far as the robotics goes, it's kind of a push into what everyone calls edge computing. And edge computing is, I mean, essentially, you could say that a laptop is an edge computer because it's away from a device, but that's not really how it goes. It's, smart TVs or robots, things along those lines, those would be considered edge computing. And so they're going to have this particular chip for those robotics. And so that'll be something interesting down the line. That's like the ultimate goal, but in the interim, it'll be sprinkled throughout things like semi-autonomous arms or autonomous arms for manufacturing, and then eventually lead to that humanoid robotics place. But really, I think that the biggest deal here is that 18A is going to be shipping as these Core Ultra Series 3, again, not exactly sliding off the tongue there, and it'll be a big test once people start using them. Will they be energy efficient? Will they be powerful enough? Those are things that Intel has been struggling with. And with Apple and its own M chips doing incredibly well when it comes to power and energy efficiency, Qualcomm catching up with their own chips as well, this is a huge test for them. And if they can pull it off, boy, Lip-Butan's life is going to get a little bit easier, but eventually they're going to try to get into that third-party manufacturing business where they'll take orders from maybe NVIDIA, maybe AMD, start building chips for them, but that'll be on a different process, not 18A, probably 14A.
Finally, while we have you, also news today, Google, Gemini, what's the latest there?
Google, as my mom calls it. So they're launching Gemini Enterprise. And basically, this is a shot across the bow at Microsoft and OpenAI. They both offer similar services in so much as you're able to access your own data and then run it through Microsoft's Copilot or OpenAI. Google's doing that with Gemini now. You'll be able to go in, ask questions using your company's own data, and then pull searches from there or get more information from your data, whether that's from Office or from Google's Docs or anything along those lines, your CRM systems. And really, this is just a way for the company to further monetize its huge investments in the cloud, in AI, while also trying to spread out its cloud offerings to continue to grow that segment, which has done very well, 22% or greater growth since Q3 2023. So this is a big deal for them. It's also, again, part of this ongoing fight we're going to continue to see between these companies as they wrestle for the lead position in the cloud and AI. It's just another kind of feather in their cap to say, oh, Microsoft's got that, so do we. OpenAI's got that, so do we. And it is interesting to see, okay, well, Microsoft and OpenAI kind of going at each other. Google's getting into the fray. What does that mean for all three? We'll just have to see. But Google's really starting to try to push further in that enterprise side.
All right, Daniel, thank you. Appreciate it. Well, power demands have surged, and not just because of AI. One company, Base Power, is looking to bridge that gap for homeowners with batteries. Executive editor Brian Kersmanc sat down with the company's CEO, Zachary Dell, and first had him explain what the company does.
Base is an energy technology company working to bring affordable and reliable power to America. So if you've lived basically anywhere in the country over the last decade, your power has gotten more expensive and less reliable. And we started the company to change that. So we install batteries on single family homes. When the grid's up and running, we use that battery to support the grid. When the grid goes down, the homeowner gets that battery to back up their home. And we're able to save our customers on the order of 10 to 20% a month on their electricity bill. So our mission is to make your bill go down and your lights stay on.
That is a good mission, for sure. I mean, all of our electric bills have gone through the roof. Where did you get inspired to come up with a business like this?
Well, I was fortunate to spend a couple years in the investment world studying the energy infrastructure space and seeing all of the progress being made in the battery space in particular. And really saw an opportunity to drive down the cost of electricity for consumers by developing battery storage technology, particularly in a way that's enabled by software to manage supply and demand and load on the grid, and really drive down price. And we've gotten off to a great start over the last 2 years, but there's a lot of work to do to make our grid here in America more affordable and more reliable. So we're off to the races and working to really rebuild the future of American power.
What type of pressures are you seeing on the grid because of this AI infrastructure rollout. That, look, I'm talking about every single day. Every day there's a new development. OpenAI is signing a new partnership for power. It's just advancing at a really, really fast pace.
Yeah, Brian, we're in an era of unprecedented electricity demand. We've really never seen demand growth like this in the category. And it's really a supply-demand problem. We have a ton of demand coming and we don't have enough supply. So we need better technology to bring more supply onto the system so that we can absorb all this new demand that's coming. And the electricity cost function plays a role in every new technology. As the cost of electricity goes down, we're able to build more, do more, innovate more. And so that's really the role that we're playing, is bringing more supply online so we can continue to absorb that increased demand and keep prices low.
Are you worried that the grid just may frazzle out? I mean, I can't think of a better word for it because of all the stress we're putting on it because of AI.
The grid is certainly under stress, and we're here to help resolve some of that stress. And we need more technology, more capacity, more flexible capacity in the form of battery storage to make sure things like that don't happen.
So how many folks or households are using base power?
We've got thousands of members across Texas, on the order of 5,000 and growing every day. We're doing roughly 30, 40 of these installs a day. That's up from 20 installs a day only a couple months ago. So we've doubled the business in a short amount of time. And we plan to keep growing at a really fast clip. I think it's been covered widely, the launch and the announcement of our first factory down in Austin. So we're going to be bringing supply to Texas, and manufacturing these systems ourselves is going to allow us to install much more batteries, many more systems across the state of Texas. And then we'll be announcing our expansion across the country soon, entering some new states and bringing affordable, reliable power, hopefully to every household in America soon enough.
$1 billion it's a lot of money. Where do you plan to invest that? I mean, I'm just hearing you now. It sounds like you're getting ready to hopefully expand outside of Texas. And then what did you learn from building out in Texas that you'll apply to some other states?
Yeah, the energy industry is big and capital intense. So, the $1 billion really helps us pull forward our strategy, which is vertical integration, right? Electricity is a commodity, and the best electron is the lowest cost electron. So with that capital, we'll further vertically integrate our business, all in an effort to drive down prices for our consumers. And really what we've done in Texas is we've been able to go execute quickly, get batteries in homes quickly, get in front of customers, get their feedback, iterate very fast. And now we have a business model that is proven and ready to expand all across the country.
It is one of the roadblocks that you anticipate dealing with regulators. I think here in New York, I can only choose one place for my electric. And then, I would love to have you in New York, Zachary. I would love to bring down my bill. But I imagine, the regulators that control these power companies, do you think they're going to be friendly and welcoming to you?
We do. We want to be the preferred technology vendor to the regulated utilities across the country. So we have partnerships in Texas today with regulated utilities where we provide all the technology, the hardware, the software, and then we allow those regulated utilities to use our technology to do the same thing, decrease cost, increase reliability. And we look forward to partnering with more regulated utilities across the country, including in states like New York.
Where are you getting the batteries from and the supplies?
We have vendors that we work with across the world. We make our own modules and packs. So everything above the cell, we do ourselves. We make our own power electronics. We do all that in Austin. And we work with suppliers across the world to source lithium iron phosphate battery cells for our product.
It really sounds like a hell of an opportunity to make what you're doing in the U.S. Of course, the Trump administration, they've really focused on made in the USA, American manufacturing. When will you start making your batteries here?
We're working on it right now. The first half of next year, we'll be ramping up our factory to production scale. So it's a near-term project for sure.
I was talking to, I just got back, Zachary, from an event in Detroit, and had a good opportunity to talk to Ford CEO, Jim Farley. His case was we can't find workers for critical industries. I would certainly say what you're doing is very critical. I mean, could you find the workers you need to make the batteries and open your plants?
Look, the talent is definitely a constraint, and this is a big part of our Series C announcement. We came out with this call to action, said, hey, join the charge, come help us build the future of American power right here in America. And we want to unconstrain that part of the business and bring more great engineers and operators into this industry and help solve this problem.
Time now, what to watch Friday, October 10th. Starting off with the Federal Reserve, we're going to be getting some more Fed commentary on Friday, this time from Chicago Fed President Austin Goolsbee. Investors will be listening closely for any clues on whether recent data, or the lack of it amid the government shutdown, could alter the timing of rate cuts. It's coming after comments from Fed Governor Michael Barr on Thursday. Barr calling for a cautious approach toward further interest rate cuts, emphasizing the possibility that tariffs could create persistent inflation. Moving over to the consumer, we're going to be getting fresh data on Friday with the preliminary consumer sentiment reading for October. Economists forecasting sentiment to drop compared to September to 54, suggesting Americans are feeling a bit less confident about their finances as inflation and job market worries linger. And taking a look at the nation's capital, we're in the second week of the government shutdown. Hundreds of thousands of federal workers are being furloughed, and key economic reports are being delayed. We're also seeing increased delays at airports across the country. The longer the shutdown drags on, the harder it becomes for policymakers and markets to gauge what's really happening in the economy.